Hi, everybody. This is John Arnsmeyer, the CEO of Small Business Majority. I want to welcome all of you to yet another of our webinars that we've been doing with the Small Business Administration on the Affordable Care Act. And we've been doing these across the country to help explain the opportunities and some of the other issues surrounding the law, which is going to take effect on fully take effect on January 1st of this year, with enrollment starting on October 1st. So at this point, I'd like to introduce, it's my pleasure to introduce Karen Mills, who's the administrator of the U.S. Small Business Administration. We've had the pleasure of working with Administrator Mills over the past 4.5 years on a whole host of issues, and just a couple of her significant accomplishments. We worked closely with her to help, and her leadership really helped pass the Small Business Jobs Act in 2010, which is the most comprehensive piece of small business legislation over a decade. During her tenure at the SBA has supported more than $106 billion in lending to more than 193,000 small businesses and entrepreneurs. And this includes 2 record years of delivering over $30 billion annually in loan guarantees in 2011 and 2012. Should also point out that, again, among her many accomplishments, the SBA has launched Startup America, passed a long-term reauthorization of the Small Business Innovation Research Program, and completely transformed and streamlined the Small Business Investment Company, the SBDIC program. As I said, we've had pleasure working with Administrator Mills, particularly on both the passage and the implementation of the ACA. And she's been heavily involved at every step of the way, making sure that the small business voice has been heard both in the crafting of the legislation itself and in the implementation. And this year, we've really had the pleasure of partnering with the Small Business Administration on this intensive program of outreach and education to small businesses across the country. So this has been a hugely successful and significant opportunity to bring the SBA's expertise in working directly with small businesses to the implementation of this incredibly important law. As many of you know, Administrator Mills is leaving the SBA at the end of the month, so I want to just say how much we're going to miss her leadership, and again acknowledge the tremendous job she's done and how much we've enjoyed working with her, and wish her best of luck in her next venture. So with that, Administrator Mills.
Well, thank you very much, John, and thank you to the Small Business Majority for your partnership on this webinar series. Welcome to all of the small business owners out there joining the call today. As John said, I am the head of the U.S. Small Business Administration, and I'm talking to you today from Washington, D.C. You know, maybe we've worked with many of you small business owners all across the country, because our job is to help you create jobs. You create 2 out of every 3 net new jobs, and half the people who work in this country own or work for a small business. So at the SBA, it's our job to make sure that you've got capital. We guarantee bank loans and access to counselors and mentors, and also to opportunities to serve the federal government as contractors. One of the important things that we are focused on right now is making sure that all of you small business owners have the facts that you need to make good business decisions about the Affordable Care Act. And I know that this is important to you. I've traveled all around the country over my 4.5 years, and I've heard from you that access to quality health care insurance is one of the most important things in your business, and it needs to be affordable. I've had small business owners tell me that the moment they felt their business was a success was the day that they were able to offer health care insurance to their employees. So we are here today to talk about exactly how the Affordable Care Act will affect you, what you need to act on, and we've got some experts with us. So we've got experts from all over the government, and I'll let them get to the details. But I do want to tell you that all of the SBA on the ground stands ready to help you navigate your way to good answers in the Affordable Care Act. We have district offices in about 100 locations. We have 900 small business development centers. You can walk into any of them. If you go to SBA.gov and you put in your zip code, you can find the names and addresses and phone numbers of folks near you. And we just put a streamlined tool on the web at businessusa.gov. That tool asks a few simple questions. Where do you live? What state are you in? How large is your business? And do you already have insurance? And with those answers, we can guide you to the resources that you need. Now, if you'd like to talk to someone, there's also a call-in number from Health and Human Services, and the number, which is also available on our website, is 1-800-706-7893. 1-800-706-7893. And you can go to SBA.gov and also get that number. So we are here today because you know how important it is to have the facts. And even after today's webinar, I encourage you to take advantage of the additional resources that I mentioned to answer any questions that you might have. With that, I'll turn it over to our experts who can give you more information about the law itself and walk you through the better healthcare options that are opening up to small business owners and entrepreneurs. Thanks so much for joining us. I'll hand it back to John.
Well, thank you, Administrator Mills, and again, thanks to you and your team at the SBA for playing such a significant role in helping small business owners really know what they need to know for the law as the law gets implemented. With that, I wanted to introduce our next speaker, who's Meredith Olafson, the Senior Policy Advisor to the SBA Administrator. Ms. Olson is responsible for overseeing the SBA's education and outreach efforts around healthcare and the Affordable Care Act. So, Meredith?
Thank you so much, John. It's a pleasure to be here today. As Administrator Mills mentioned, we advocate on behalf of America's 28 million small businesses, and we are working hard to make sure that you have the information you need to understand the benefits and the opportunities under the Affordable Care Act. So what we wanted to do today in the webinar is cover some of the key pieces of the law that you should know about as small business owners, and that includes some key insurance reforms that are helping to level the playing field for small businesses. We will touch on three main topics today: the Small Business Healthcare Tax Credit, which is available to for-profit and nonprofit employers, and we'll talk about the eligibility rules around those tax credits. We'll also talk about the new marketplaces. This is an exciting new opportunity for small business owners to purchase private health coverage, to compare plans, starting in 2014, with enrollment beginning in October of this year. And then finally, our third main topic will be the employer shared responsibility rules, also sometimes called the employer mandate. We'll talk about which businesses are covered by those rules and what do they look like. And then finally, we'll talk on a few pieces about that might affect self-employed folks, and we'll give you links to some additional resources, and then open it up to questions in about the 10 minutes or 15 minutes we have remaining at the end of the presentation. So with that, let's go ahead and get started. And the one thing I want to flag before we launch into this is a closed press webinar. And if you have any questions at all about information you're hearing today, and you wish to publish anything based on today's webinar, we encourage you to first contact the SBA's press secretary, Emily Cain, at emily.cain, C-A-I-N, @sba.gov. And with that, let's go ahead and get started. For years, we know that small businesses have reported that their number one concern has been access to affordable care. And, historically, small businesses have paid, on average, 18% more than larger businesses for health insurance. We'll talk today about ways that the Affordable Care Act is helping to level the playing field for small business owners, increasing access, helping to lower premium cost growth so that small businesses can provide the health care that we know they want to provide to their employees on a more level playing field. A couple of things I wanted to highlight before we launch into the three main topics. When the Affordable Care Act was passed, it worked hard to address at the outset some of the inequities that prevented small employers from covering their workers. Things like fewer choices than large companies, higher premiums and unpredictable rate increases, higher rates for groups with women and older workers, as well as those with chronic health conditions or higher cost illnesses, and then often longer waiting periods or no coverage at all for folks with pre-existing conditions. So the ACA, when it was passed in 2010, immediately put into effect two insurance reforms that are helping to level the playing field for consumers and small businesses. First, for the first time, insurance companies face limits on administrative spending. So now insurance companies have to spend at least 80% of consumer premium dollars on actual medical care, as compared with overhead costs, salaries, and the like. And if your insurance company exceeds that limit, it must provide a rebate of that portion of the premium dollars that go beyond that limit. Also, right away when the Affordable Care Act was passed, insurance companies had to publicly disclose certain rate hikes, generally those of 10% or more, and explain the rate hikes to the state or the federal government before the rate hikes take effect. This helps with the transparency for double-digit rate increases. And again, that went into effect immediately in 2010. And then looking ahead, in 2014, insurance companies can no longer charge higher rates or deny coverage because of chronic or pre-existing conditions. They can't charge higher rates for women. They will, for the first time, need to pool risks across small groups, just like large businesses have been able to do. There will no longer be annual dollar limits on coverage. And finally, all plans that are offered in the small group market and the individual market must provide a certain core set of essential health benefits. These are about 10 or so benefits that all plans must provide. Two of the reforms we'll talk about today in more detail are the small business tax credit and the new marketplaces. The tax credit has been available since the law was passed in 2010. And it's a tax credit worth up to 35% of employer premium contributions to help smaller businesses offset the cost of providing insurance to their employees. And then we'll talk again in detail during the presentation about the new health insurance marketplaces. These marketplaces will open in all states for enrollment in October, and they will allow our consumers, self-employed folks, and smaller employers to have access to a range of health options, private health plans, no matter where they're located. I put this slide up here. We won't go into it in detail, but I wanted to give you all a sense of some of the other insurance reforms that are making a difference across the board, just to provide a little more context around the Affordable Care Act. But again, please feel free to go back when you receive these materials after the presentation via email to look at this slide at your leisure. So as we head into the main content, what we wanted to flag, and one way to think about the Affordable Care Act and what it means for your business, is that often the way that the Affordable Care Act will benefit a business or impact a business is going to depend on the size of your workforce. So you'll see when we're talking about the tax credit, the marketplaces, and definitely shared responsibility, whether or not you can participate in the marketplace, for example, or are eligible for the tax credits, is really going to depend on the size of your workforce. So we'll look at the different size triggers that matter when it comes to these various provisions. And with that, let's head into our first topic, which is the Small Business Health Care Tax Credit. So as I mentioned, this is a credit that's been available to small employers under the law since 2010. And it is available to our smaller employers with low to moderate income workers. So what does that mean? It means if you're a business with 24 or fewer full-time equivalent employees and you have average annual wages below $50,000 and you contribute 50% or more toward your employees' self-only premium costs, then you're eligible for this tax credit. Right now, it's a credit of up to 35% of the employer's premium contributions. As I said, if you're a nonprofit entity, you are still eligible for this credit. It would come in the form of a refund. And for nonprofit entities, it is a credit right now of up to 25%. The credit works on a sliding scale. So the maximum credit is the 35% right now, and that's available to employers with 10 or fewer full-time equivalents and average annual wages of less than $25,000. And then as you get above the 10, all the way up to 24 full-time equivalents, and all the way up to wages just below the 50,000 mark, that tax credit adjusts downward incrementally. So again, maximum credit available to employers with 10 or fewer full-time equivalents and average wages of less than 25,000. Couple of questions we get a lot: how are the full-time equivalents determined? The full-time equivalents for the purposes of the tax credit is based on a 40-hour work week. So essentially, you would add up the total hours of service for all of your employees for the year and divide that total number by 2,080, and that would yield your number of full-time equivalents. The IRS has a great set of tools and resources to help business owners calculate their full-time equivalents, calculate their average annual wages, and all of that's available at irs.gov/ACA. Again, irs.gov/ACA. So you can go on, there's an estimator that business owners can use to figure out if they meet these eligibility criteria and then what the tax credit might look like. So as I said, right now and continuing through this tax year, it's a credit of up to 35% for for-profit folks and 25% for nonprofit employers. Important to know that if you are eligible for this credit and you take the credit, you can still deduct the remainder of your premium contributions. So you would be able to benefit both from the credit and the partial deduction for the remainder of your contributions. Starting in 2014, this tax credit actually goes up to 50%. And to take advantage of the credit, you would need to meet the 3 criteria that I mentioned based on size, wages, and contributing at least half towards your employees' premiums. And also purchase coverage through the new marketplace, which we'll talk about again during the presentation. The new marketplace for small employers is known as SHOP, which stands for the Small Business Health Options Program. So if you go into the SHOP program to purchase coverage for your employees and you meet the other criteria, you should explore being able to take that tax credit. And then the 2014 tax credit, the enhanced amount of 50%, can be claimed for any 2 consecutive taxable years. We always want to note that this is a federal tax credit, that some states may also have additional credits available, and so it's worth checking into that depending on your location. Just a summary of the tax credit eligibility criteria. And then this slide just highlights kind of the next size category that we'll move into, which is businesses with up to 50 full-time equivalent employees. So again, if you're a business with up to 24 full-time equivalents, you should explore the tax credit. If you're a business with up to 50 full-time equivalent employees, you'll be eligible to purchase in the new marketplace, the SHOP marketplace, starting in January of 2014. And with that, let's look at what these marketplaces are. So as I mentioned, under the Affordable Care Act, one of the big reforms was to create a new health insurance marketplace for consumers, for self-employed folks, and for small employers. And this marketplace will go live in all states in January. Enrollment will start in October of 2013. And for small employers, you'll come into the marketplace through that segment that is uniquely devoted to small businesses, again called SHOP. So SHOP is part of the new marketplaces. It is dedicated to small businesses. And a couple of things that you can expect to see in the SHOP marketplace: it will spur competition for customers for your business and other business owners based on price and quality rather than by avoiding risk. It will offer access to health insurance plans that must include that core set of essential health benefits that I mentioned earlier. So things like coverage for doctor's visits, preventative care, hospitalization, and prescriptions will all be part of this core set of health benefits that must be offered through the SHOP marketplace. Small employers will also, for the first time, be able to pool risks across other small businesses and reduce their administrative complexity, thereby helping to bring down costs. And then the marketplace will work with some of the insurance reforms I talked about at the beginning of the presentation, along with the small business healthcare tax credit, to help level the playing field for small business owners. So just to give you a little more information about the SHOP marketplace and what it will offer, it will give employers a choice of qualified health plans from different health insurers. These plans will be assembled in a single place, making it easier for employers to make apples-to-apples comparisons between plans based on price, benefits, and other characteristics. The SHOP will also provide a streamlined application for employers and employees to enroll in qualified health plans. We know that many employers may still find it easier to work with their agents or brokers to make health choices through SHOP, and the SHOP welcomes participation from agents and brokers. Some help will also be available to you through the call center that Administrator Mills mentioned at the beginning of today's session, as well as navigators. And navigators are grantees either of the states that are running their own marketplace or through the Department of Health and Human Services, and these navigators will be able to provide in-person assistance to consumers and small businesses as they look to enroll in the marketplace. So who's eligible to enroll in SHOP? Generally, for the first couple of years, SHOP will be open to small employers with 50 or fewer full-time equivalent employees. In 2016, that will expand, and employers with up to 100 full-time equivalents will be eligible to participate. To make it easier for the new SHOP marketplace to get up and running, insurers can continue to use the state's established method of how they count full-time employees to determine eligibility for the plan years of 2014 and 2015. And it's really important to know that once an employer enrolls in the SHOP program, they can expand their workforce and still continue to purchase coverage through SHOP. Again, employers can enroll starting in October 1 of 2013 for coverage that would begin in January. And thereafter, employers will have a monthly enrollment opportunity through the SHOP program. So again, employers can enroll through their agents and brokers who are registered with the SHOP marketplace. They can also enroll directly through SHOP. If you visit healthcare.gov, and we have that website up on the page now, you can get more information now about the health insurance information, as well as sign up for email and text alerts in advance of the October enrollment period. The other thing I wanted to flag is that under a rule that was issued at the end of May in 2013, the SHOP marketplace in all states would give the employer the option to offer their employees a choice of qualified health plans from different providers starting in 2015. Some states may offer this option, this employee choice option, starting right away in 2014. And a lot of that will depend on whether your state is running its own marketplace. Those would be states like California or New York or Oregon that have said they're going to run the functionality of their marketplace. Other states have chosen to partner with Health and Human Services to run the marketplace, and then other states have asked the Department of Health and Human Services to operate the marketplace. But no matter whether it's a state-based marketplace in your location or whether it's a marketplace that is run through the Department of Health and Human Services, all the marketplaces will still open with plan offerings beginning in January of 2014. So with that, let's move to the third topic, employer shared responsibility. These rules will take effect in 2015. Recently, the Department of Treasury issued some transitional relief to employers who are covered by the shared responsibility rules, indicating that these provisions will now take effect in 2015. They were originally going to take effect in 2014, but because of this transitional relief period, employers will now have an additional year to plan for and prepare for these rules. So let's talk a little bit about who is covered by these rules and what do the rules look like. So the first thing that we tell business owners when we're talking about these rules is that, again, this is where size matters. So if you're a business with fewer than 50 employees, and that's about 96% of all firms in the U.S., then these shared responsibility rules do not apply to you. So if you're a business owner, again, with less than 50 employees, then you are not subject to the employer shared responsibility rules at all. And again, that's about 96% of firms in the U.S. Of the remaining 4% of businesses that do have 50 employees or more, we know that the majority of them are already offering coverage to their employees. So one thing, one of our key roles here at SBA is to make sure that business owners understand the facts around these rules, and that we're helping business owners kind of cut through the misinformation and make sure they understand who do these rules apply to and how do they work. So again, who's impacted by these rules? It is business owners that have 50 or more full-time or full-time equivalent employees. So let's look a little bit about how do you figure out if you meet that threshold. So some of the important definitions to know that apply to the shared responsibility rules and that will help you as a business owner figure out if you're subject to these rules are that full-time is defined under the shared responsibility requirements as an employee who is employed on average 30 hours per week or more, or at least 130 hours per month. So again, when we looked at the tax credit, that was based on a 40-hour work week, and so full-time equivalent was based on 40 hours. Little different for the shared responsibility rules. For these rules, you're full-time, you're considered full-time if you are working on average 30 hours a week or more. And therefore, a full-time equivalent would be a combination of employees who by themselves are not full-time because they're not employed at least 30 hours a week, but together they'd be counted as the equivalent of a full-time. So if you've got two employees each working 15 hours a week, you would add them together to get the one full-time employee. And then the other thing we want to flag for folks when you are trying to figure out if you're subject to these rules or not, and you see that the threshold is 50 or more full-time or full-time equivalent, the other important thing to know about are controlled group employers. So what does this mean? It means that employers that have common owners or those who are otherwise related to one another would be added together to figure out whether they meet that threshold number of 50. So if you've got several businesses with common owners, and those businesses employ a range of size of workforce, you would need to add all of the employees of all of the businesses together to figure out if you meet that threshold number of 50. And if you do, then all the businesses that are part of the control group would be subject to the employer shared responsibility rules. So again, as a basic threshold question, business owners will want to look at the number of full-time folks they have, add that together with the number of full-time equivalent employees that you have, and if it averages for the year 50 or more, then you would be subject to the employer shared responsibility rules. So that's kind of the first question that as a business owner you would want to ask yourself to figure out whether you're even covered by the shared responsibility rules. And then the next kind of question is, okay, as a business owner, I've sat down with my tax and legal advisors. I know that I'm subject to these rules. What do the rules mean? What do they look like? And at this slide, we've given you an overview of what the employer shared responsibility provisions are. So if you have 50 or more full-time or full-time equivalents, then there are two scenarios in which you may owe a shared responsibility payment. And they are the following. Either you as a business do not offer coverage to at least 95% of your full-time employees. Again, that's those employees working at least 30 hours a week and their dependents, or the coverage that you offer to your full-time employees is either not affordable or doesn't provide minimum value. And we'll look at what those terms mean. If either of those scenarios is true, and at least one of your full-time employees goes to the new marketplace and is eligible to get a premium tax credit, and we'll talk about that, then you may owe a shared responsibility payment. So I know it's a lot to digest in one slide. We will break it down in the next couple of slides, but wanted to provide you with this framework to help you understand as we move through this what the two potential scenarios are. So again, either the business is not offering coverage to at least 95% of its full-time folks and their dependents, or the coverage that's offered isn't affordable and doesn't provide minimum value, and at least one full-time person that works for you receives a premium tax credit in the marketplace. So let's look at some of these definitions that we've talked about. I said under the second scenario, an employer who may owe a payment if they've offered coverage to their full-time employees, so at least 95% of their full-time employees, but that coverage either doesn't provide minimum value or it isn't affordable. So what do those terms mean? Coverage provides minimum value if the plan itself covers, on average, at least 60% of the plan's total costs. So that means the plan is covering at least 60% of the costs of incurred benefits. HHS and IRS have developed an online calculator that employers can use to help figure out if their plan meets the 60% threshold. It's an actuarial value, and we've got links to that calculator on our website. Also, if you go to businessusa.gov, you can find links to both this calculator as well as a handy guide to figure out how to count your number of employees to determine whether or not you meet that 50 threshold that I mentioned. Coverage is deemed affordable if it's essentially based on the employee's wages. And so under the law, coverage would be not affordable if the full-time employee's share of self-only coverage costs more than 9.5% of household income. Since most employers won't know household income for their employees, the IRS has said employers can use what are called safe harbors. And one of the safe harbors looks at the W-2 wages. So if the cost to the employee of a self-only plan is no more than 9.5% of his or her wages on the W-2, then it would be considered an affordable plan for the purposes of the employer shared responsibility rules. So going back to our two scenarios, let's look at what the potential payments might be based on the two scenarios that I described at the beginning of the discussion. So the first scenario on the left-hand column is that as an employer, you've not offered coverage to at least 95% of your full-time employees. If that's the case, then payment would apply if any of your full-time employees receives a premium tax credit in the new marketplace. And in that case, the payment owed would be $2,000 per year times the number of the business's full-time employees minus the first 30. So if you've got 60 full-time employees and you fall under this scenario where you haven't offered coverage to at least 95% of your full-time folks, then the payment you may owe may be $2,000 a year times 30. So that would be times your 60 full-time folks minus the first 30. It's important to know the payment will be calculated separately for each month in which coverage wasn't offered to your full-time employees. And again, the payment is based on your total number of full-time employees minus the first 30. So that's the first scenario, and those are the potential payments. The second scenario would be if the employer offered coverage to the majority of its full-time folks, so at least 95%, but the coverage either wasn't affordable, as based on the definition we looked at, or didn't meet that 60% actuarial value. In that case, the payment owed would be $3,000 per year times the number of full-time folks who actually go to the marketplace and get a premium tax credit. So as distinct from the first scenario, the payment in this scenario on the right-hand column is based on the number of full-time employees who are getting the premium tax credit. The monthly payment would be $250 per month, which is the $3,000 payment divided by 12. And it's important to know that no matter what this payment ends up being for an employer, it can never be greater than the payment under scenario 1, and that's because an employer who did offer coverage, but it wasn't affordable and didn't meet minimum value, would never pay more in the shared responsibility payments than an employer that did not offer coverage to most of its full-time folks. And when I say employer for the purposes of these rules, this includes for-profit employers, nonprofit employers, and governmental entities. The other thing I wanted to flag is that the payments that are outlined in this slide are based on 2014 figures. Since these rules now will not take effect until 2015, there will be a cost of living adjustment for any payments that would be owed starting when the rules take effect, so after the 2015 effective date. So some things to know about these rules. I've talked a lot about the payments and them being triggered by the full-time folks going to get a premium tax credit. So it's really important to know that no employer payment would be owed for non-coverage of part-time folks. So even if one of your part-time employees, somebody working less than 30 hours, gets a premium tax credit in the marketplace, there would be no employer payment owed as to that part-time employee. Now might be a good time just to give you all a sense of who's eligible to receive the premium tax credits, because again, it's the premium tax credit that triggers the shared responsibility payment. So generally, an individual, an employee, is eligible to receive a premium tax credit if they have income between 100% and 400% of federal poverty level. That's roughly up to about $45,000. They haven't been offered employer coverage, or the coverage that they were offered wasn't affordable or didn't meet minimum value, and the employee wasn't eligible for something like Medicare or Medicaid. So if one of your employees is eligible for Medicare, or if you're in a state that expanded Medicaid and the employee is eligible for Medicaid, they would not be eligible for the premium tax credit. Likewise, as I indicate here on the second bullet, if you offer affordable coverage that provides minimum value to a full-time employee, and that employee just declines your offer of coverage, you would not owe a shared responsibility payment for that employee. Likewise, you wouldn't owe a payment if an employee gets coverage through a means other than the individual marketplace. If they're covered through their spouse, for example, then no payment would be owed. And again, that's because the payments are based on the receipt of the premium tax credit in the marketplace. Also want you to know that to avoid payment, employers that offer coverage to their full-time folks must also offer coverage to the dependents of the full-time employees. For this purpose, dependent is defined as children under the age of 26. So this definition of dependent does not include spouses. The cost of providing coverage, as you know, is tax deductible by the employers. By contrast, the shared responsibility payments that we talked about today are not tax deductible. So let's talk a little bit about some things that self-employed folks with no employees will want to be thinking about under the Affordable Care Act. Starting in January of 2014, the Affordable Care Act calls for all individuals to have a minimum baseline of coverage, known as minimum essential health coverage, for every month of the year, qualify for an exemption, or make an individual shared responsibility payment when they file their tax returns. And so some of the exemptions from this rule would be things like affordability, hardship. There are religious exemptions. We've got additional content at our site, sba.gov/healthcare, to help individuals figure out what the different exemptions are, more about what these individual shared responsibility requirements mean, and where to go to get more information. Minimum essential coverage includes things like employer-sponsored coverage, Medicare, Medicaid, CHIP, etc. And then it's also important to know, and this is a question we get a lot, what if I am a business owner with no common law employees, I'm a sole proprietor, I don't employ other individuals, where do I purchase coverage if I choose to do it through the marketplace? Sole proprietors without common law employees would not be eligible to purchase coverage through the shop marketplace that we talked about, but they would be able to purchase coverage through the new individual health insurance marketplaces. And again, the individual marketplace and the shop marketplace, all part of the marketplace concept, but they're just segmented for individuals versus small employers. And again, if you're an individual, a sole proprietor with no employees, you would be able to start enrolling in the individual health marketplaces also starting in October of 2013. What's some of the advantages of doing it? So obviously not required as a business owner or an individual to purchase coverage through the marketplace. On the business side, you'd be able to take advantage of the enhanced tax credits that we talked about, the streamlined experience, the ability to make these apples-to-apples comparisons, to pool your risk across other small businesses. For individuals, you may be eligible, if you decide to purchase coverage through the marketplace, for premium tax credits and other cost-sharing reductions on a sliding scale. So some other provisions that we just wanted to touch on today. We won't have time to go into them in detail, but I wanted to make sure that you all knew about some additional provisions as business owners that you'll want to be thinking about. Some of these may already be familiar to you. Right now, under the Affordable Care Act, there are summary of benefits and coverage disclosure rules, providing information about the kind of health benefits you provide to your employees. We talked earlier today about this requirement that insurance companies spend at least 80% of your dollars on actual medical care, and if they don't, they have to issue rebates. So these are called the medical loss ratio rebates, also known as the 80-20 rule. There are ways that employers will need to think about what to do with those rebates. We've got more information about these provisions also on our website, sba.gov/healthcare. W-2 reporting requirements regarding annual healthcare costs. Note that if you filed fewer than 250 W-2s in the prior year, you would not be required to make this W-2 reporting. And then the annual tax deductible cap for employee contributions to flexible spending accounts. Looking ahead to 2014, we'll see new maximum waiting periods. Starting in 2014, plans won't be able to impose waiting periods of more than 90 days for otherwise eligible new hires. There are new incentives for workplace wellness programs that will take effect also in 2014. And then looking ahead to 2015, I talked about how the employer shared responsibility rules will now take effect in 2015. And along with that, there are a companion set of rules that require employers to make new information reporting requirements to the IRS that details the kind of health insurance they offer, their full-time employees, and the affordability aspects of the employer shared responsibility rules. Look for more information and guidance from the IRS this summer about what these reporting requirements look like. But again, if you're covered by the shared responsibility rules, so you're about one of those in the 4% of businesses who have 50 or more full-time or full-time equivalents, then you will have these companion reporting requirements. The IRS will use these reports to help determine whether or not an employer owes the shared responsibility payments. And then also in 2015, there'll be new reporting requirements for issuers of health insurance coverage. That would apply to employers of any size that have self-insured health plans, as well as to insurance companies. So more information about all these provisions can be found at our website, sba.gov/healthcare. And with that, just a few links to some of the sites that I mentioned today, along with the Department of Labor's website. The Department of Labor is regulating things like the Workplace Wellness Program. The other final thing I wanted to flag before we open it up to questions is The other provision that will go into effect or that employers will need to be thinking about by October 1 are what are called the Fair Labor Standards Act notices. And what this means is if you're an employer covered by the Fair Labor Standards Act, then you'll need to provide your employees with notification about the new marketplaces by October 1st of this year. So again, you can get more information on that at our website. And then, as we mentioned at the beginning of the call, the administration launched a great new tool, a healthcare tool that businesses can use at business.usa.gov. Again, business.usa.gov. If you enter your location, your size, and the status of whether or not you offer insurance coverage, you'll then be led to a set of resources that are filtered unique to the fields that you've entered. It's a great healthcare tool, and we continue to work to refine and update it. Definitely encourage folks to check it out. It is aggregating content across all of these sites, so really meant to be a one-stop tool for business owners. And with that, we're happy to take questions in the 13 minutes or so remaining. And I think I'm joined here today by my colleagues from the Centers for Medicare and Medicaid Services, who are on hand to also help answer questions about the marketplaces. So with that, we will take a look at the questions that have come in and try to answer as many as we can in the time remaining.
All right. Hi, this is Brooke Bell from the shop team, and we have a couple of questions here that have come in that we would like to answer. The first question is from an employer with 24 or fewer employees. The average salary for those employees is more than $50,000 per year, and the question is whether they are eligible to purchase insurance through the shop or just ineligible to receive the tax credit. Well, in this situation, you would be eligible to purchase health insurance through the shop, but you would not be eligible for the small business healthcare tax credit. The small business healthcare tax credit is for employers with less than 25 employees, but your employees exceed the overall salary requirements. So in order to access the tax credit, your average employees must make less than $50,000 per year. The next question we have is from an employer who's asking about his options with employees in multiple states. The question is, if we employ staff in multiple states, how do we shop for insurance through the shop? In the shop, you actually have two options for an employer with employees in multiple states. You can purchase shop coverage through one state shop, and in that instance, you would want to make sure that the coverage that you choose provides coverage to the other states in which you have employees. Multi-state plans will be sold through the shop, and in that instance, you would want to look into that option. You also have the option to enroll in multiple state shops. An employer can enroll in each state shop in which they have a business location, and that can be an actual office, or if you have an employee who works from home, that address would also count as a business location. So then you could choose to enroll in multiple state shops where you have employees. We have another question, and the question is, my current plan renews every year in April. Will I be eligible for a special enrollment period based on my current renewal option? The answer here is yes. You would be eligible to enroll in shop coverage and qualify for a special enrollment period for your employees. The deadline to enroll in order to have April 1st coverage would be March 15th. So So you would need to make sure that your application is complete by that time. And we have one more question. The question is, if I am a new entrepreneur with 2 full-time employees, is my business eligible for the Affordable Care Act? In this instance, you would be eligible for SHOP as long as you are providing each employee coverage. And you might also be eligible for the small business tax credit depending on the salary of those workers. Meredith, do you have any other questions that you'd like to answer today?
Yes, thanks so much, Brooke. So some additional questions we're getting about the tax credit, for example. Can nonprofits claim the credit even if they don't owe taxes? Yes, they can. So nonprofits are eligible for the tax credit. As I mentioned, if you're a nonprofit now, it would be a credit of up to 25% of your premium contributions, and that credit will rise to 35% for nonprofits starting in 2014 if they purchase coverage through SHOP, and it would come in the form of a refund. So tax-exempt folks would get a refund. Businesses, for-profit entities would get a credit. Other question we're getting about the Fair Labor Standards Act notice that I mentioned. So again, that notice applies if you are covered by the Fair Labor Standards Act. Then you must notify your employees of the marketplace by October 1st. Any new hires would need to be notified going forward starting on October 1st. The Department of Labor has actually crafted a couple of model notices that employers can use to help provide that notification to their employees. We've got links to those 2 model notices at our website, sba.gov/healthcare. And one notice would be used if you do offer coverage to your employees, and the other model notice applies if you don't offer coverage. So again, those are just guides. They're templates employers can use. You're not required to use them. But if you find it helpful, folks, they're meant to be used as a model notice. So other questions we're getting, just a quick mention again of that new healthcare tool at business.usa.gov. Again, business.usa.gov. Couple of other things. So with regards to the tax credit, we're getting questions about family members and owners. Are they eligible to, how does that work as far as taking advantage of the credit? So owners of businesses and their family members would not be counted for the purposes of the credit. So if you've got fewer than 25 full-time equivalent employees, that would exclude you as the owner, for example, and it would exclude family members. So your wife, your sons and daughters, other family members would not count as part of that FTE calculation. And so you would want to, if you have a family-owned business or you've got employees working for you or non-family members, they would be kind of separated out for the purposes of figuring out whether you meet that threshold of fewer than 25 full-time equivalents and average annual wages of below $50,000. Again, the IRS has some great resources for business owners to navigate the tax credit, and I definitely encourage folks to take a look at the irs.gov site to get more information about the tax credit. Back to the SHOP marketplaces, getting a question about what if I'm a sole proprietor or the shareholder of more than 2% of an S corporation, where do I purchase coverage? So sole proprietors, shareholders of more than 2% of an S corporation, and their immediate family members would be considered individuals and may buy coverage through the individual marketplace, but not through the SHOP program. Let's see. So again, getting a question back to and let me see if I can flip back in my slides, the employer shared responsibility rules and affordability. So let's pull that up again. So again, if you are a business owner with 50 or more full-time or full-time equivalent employees and therefore subject to these shared requirement rules, one aspect of those rules says that if you offer coverage to 95% of your full-time employees, it must be affordable and provide minimum value in order to avoid the shared responsibility payment. Affordability is based on the household income, but as I said, since most employers won't know what their employees' household income is, the IRS has given employers 3 different safe harbors that they can use to figure out affordability. The one that I've highlighted on this slide, number 23, is the W-2 safe harbor. So if you offer a plan to your full-time employee and the cost of that plan, of the self-only plan, is no more than 9.5% of that employee's wages, then it would be deemed affordable. The other safe harbors, which aren't included on this slide, are based on rate of pay and the federal poverty guidelines. So again, we've got more content at our website. You can also find tools at the business.usa website that I mentioned to help you figure out, do I have 50 or more employees? If I do, what do these rules look like for me? Just flipping through some of the other questions that we've gotten. Getting a question about seasonal workers and how seasonal workers, how they work in terms of the employer shared responsibility rules. So I mentioned before that a business owner, in order to figure out whether it has 50 or more full-time or full-time equivalent employees, would add up all of its full-time folks, so anybody working at least 30 hours per week, add that together with any of its non-full-time people, so part-time folks, seasonal workers would be included as part of that, and if you meet the threshold of 50 or more, you'd be covered. There is a seasonal worker exception, and here's what it looks like. If your workforce equals 50 or more full-time or full-time equivalents, and you're exceeding 50 for 120 days or less, solely as a result of your seasonal workforce, then you would be exempt from these rules. So to say it another way, if you are above the 50 threshold for about less than 4 months a year, so 120 days or less, and the only reason you're above the threshold is due to the seasonal workforce, then you would not be subject to the shared responsibility rules. So that's a question we get a lot, and it's something to be aware of. Again, the other thing to be aware of when you're trying to figure out the 50 or more threshold is the control group rules that I mentioned. Common owners or businesses that are otherwise affiliated would need to take that into account to figure out whether they get to the 50 or more employee. Let's see, the last question. So what are average annual wages for the purposes of the tax credit itself? So the way to figure out the amount of your average annual wages is to add up the total wages that you've paid during the year and divide that by the number of your full-time equivalents, and that will yield the total average annual wages for the purposes of the tax credit. And with that, I think we've unfortunately reached the 3 o'clock hour, and we'll have to conclude our session. We really appreciate folks joining us today and engaging in this, and continue to urge people to take advantage of the resources that I mentioned online. We also have resources at all of